shelter is the largest component of the consumer price index. So that includes both rent that people are paying for primary residence and owner's equivalent rent, which is what a homeowner would pay in rent if they were to sell their house and go rent as a primary residence. So I'm showing rent, full shelter year over year in the orange line, and you can see it's still elevated at plus 5.4% year over year. But the encouraging thing is that the measures within shelter, like I mentioned, rent, owner's equivalent rent, they are easing just at a frustratingly slow pace. This was not necessarily the component that was primarily responsible for the downward surprise this month, which to me actually is another encouraging element, just because if you're getting good readings without some of the rent statistics being really supportive, then to me, the fact that you still have some downward pressure on shelter still to come indicates just further downward trajectory on inflation. So at least that's just one way to take it. Basically just telling me that there's more disinflation in the pipeline as we work through this year. And so, overall, it remains to be seen exactly how the Fed interprets this, because Vince, you and I were talking about this yesterday, how it was interesting. CPI came out on a Wednesday, the Fed was meeting, right? And, they released a summary of economic projections. Kind of tough to tell, because did they adjust their expectations based on this report or not? I don't really know.
Right, yeah, it was pretty interesting because they did a dot plot back in March, and the median estimate for cuts was 3. And just recently at the June meeting, their median estimate was only 1 cut. And during the press conference, when they were asked if they took into consideration the CPI values that came out that morning, they said that they were able to adjust, but he didn't mention if anyone actually did.
Right, yeah, ultimate caution, right?
Yeah.
When you say dot plot, can you just explain what exactly that is and why it's important?
Yeah, absolutely. So there's 19 members in the FOMC and only 12 are voting members, but all 19 put an estimate on the dot plot for when or how many cuts they expect at a certain point in time. So the one we're looking at is at the end of 2024, how many cuts does each person expect? So they put their dot on there for 1, 2, 3, however many, and then the number that people talk about is the median typically.
Got it.
So,
and cuts is related to basically they're voting on how many 25 basis points or 0.25% rate cuts do they expect to the federal funds rate.
Yep.
Yeah. So, like I said, overall, this is a positive sign in my eyes. I mean, the market obviously liked it because, the market's operating under the assumption of, lower than expected inflation print equals more supportive Federal Reserve, less interest rate pressure equals stocks go up, essentially.
Well, I think this also highlights, the stubbornness of the shelter component. I mean, it really highlights and what in all likelihood is going to be a multi-year investment within the housing sector in the U.S. economy, right? I mean, we clearly have a supply issue here, supply-demand imbalance. People aren't moving. They feel locked into their low rates. How could I sell my house? I'm going to have to pay as much or more to downsize. I think that's what I hear a lot of people say. And until we can build enough supply to ease this imbalance, it's tough to see what's going to get housing back to what we call normal levels. And when I say housing, I'm talking about houses available for sale. So even though inventory's up 30-some% this year, it's still below historical averages, kind of the pre-COVID levels. And it's ironic, the Fed thought they could slow the housing market down by increasing interest rates. This is their main tool to affect the economy. But in reality, it's almost had this unintended consequence where now current homeowners feel trapped. They don't want to sell, so supply is greatly depressed.
Yeah, and it's anyone that is looking to buy a home is kind of snookered, because it's the natural assumption is I wait for better prices, right? I'm going to wait till interest rates come down so my total monthly cost is lower. Well, what's going to happen when you do get a tick down in 30-year fixed rate mortgages? you're going to get a flood of buyers coming into the market, right? So I'm kind of with you where I'm not convinced that this is going to be a quick solution. We've talked about in the past how home builders are not incentivized to build what I would call affordable homes for those people that are looking for homes right now.
Right, starter homes.
Starter homes, right? Home builders can't make a well enough profit on those starter homes, call it in the $200,000 and $350,000 range. They mostly build that, 2,500 square foot, $500,000 house, because that's where they can essentially make it worth their while.
Yeah, maximize margins.
Yeah. There's a lot of funkiness that happens in the reporting of the shelter component of the consumer price indices, but it's also like a ridiculously high portion of CPI, and that's not a explicit cost that individuals bear every month. So there's a lot of weirdness that happens, and that's kind of why we like to look at multiple measures of inflation, whether it's the CPI indexes or personal consumption expenditures, which is the Federal Reserve's favored measure of inflation. But you got to parse it together with everything else that comes out, like retail sales this morning that came out super soft for the second straight month. So all in, what this points to me is just that the trajectory is intact. There's been some moderation in some of the really high flying categories in terms of price increases. And, at the end of the day, we have inflation that's on a core basis up 3.4% year over year. Keep in mind, some of the best equity performance, at least from the domestic market, has come when CPI is in the 2 to 3% range. So some encouraging signs, and there's certainly some more to watch, and this will remain in focus for the very foreseeable future.